Carrington, good morning. So, really, the bank has decided, hasn't it, inflation is a bigger problem than banking stress.
Yeah, I think that's right. At this point, Jerome Powell says that the Federal Reserve still needs to be hiking interest rates because inflation is just not cooling at the rate that it needs to for them to be confident that they are actually dealing with this problem, which is still running at multi-decade highs. They say a week is a long time in politics, but I think financial markets also have problems with how quickly events come up at them fast. A few weeks ago, Jerome Powell was preparing the markets for a hike of about 0.5 percentage point because of those recent inflation numbers showing that inflation was firmly embedded. But then we had the collapse of these two banks. The 16th largest in the US was the first to go, Silicon Valley Bank, and then Signature Bank went under as well. They've had the regulators moving quickly to shore them up and to guarantee deposits, but then the failure we saw in recent days of Credit Suisse needing to be taken over by UBS shows that this is a massive problem. And today, Jerome Powell was trying to restore confidence in the American financial system.
Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again.
And an acknowledgement there from Jerome Powell that the Federal Reserve may have dropped the ball in regards to its regulation of these banks because it has this dual role. It's not only setting interest rates, but it's also supposed to be keeping an eye on the financial system to ensure that these banks are acting in a way that keeps the system robust. But Jerome Powell promising there that he is willing to do whatever it takes to ensure that the system continues to work. It now looks that like interest rates in the United States will continue to go up. We're thinking maybe another 0.25%, but perhaps they won't go as high as has previously been forecasted. And that's partly because banks are now starting to tighten their own lending standards because they're under pressure, not only from regulators, but also they recognise that there is now more risk in the global economy, and so therefore will make it harder for people to get loans off them. So that in turn basically acts like an interest rate hike being taken independently by the banks. So maybe take some pressure off the Federal Reserve, but it's still an interesting road ahead, to say the least, for the Federal Reserve.